Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Thursday. It's the 10th of was it 10th of December? What is it? We're in November. Just to show you how whacked out my timing is. I don't even know what month we're in right now. The year's just going by too fast. I'm thinking December, November, October. I'm all over the place. I wanted to do the video just a little bit later today, which I'm doing. It's about 8:30, and the CPI is about to come out. Now, heading into the CPI, let's see. We were up just a bit, about 86, 85 points, and the Nasdaq is up about 54. The bond market is up just a hair. It'll be very interesting to see how these numbers come out. So just so you know, we're expecting 8% year over year on the highlight number and 6.6. Now, if this number is above 6.6, that means the odds of going 0.75 go higher. If we're below 6.6, the odds of going 0.75 are lower. Now, what I'll do is this. The report is coming out right now. I specifically timed this report to come out with my analysis. So what I'll do is I'll get into the morning report, talk about what could go either way. We'll keep an eye on the bond market, which is still kind of holding steady. A lot of volatility is expected today. And then we'll find out what the number is, and maybe I can give you a full analysis in the video. So this video doesn't give you, the CPI is coming out. Basically, this video will give you an analysis of the CPI. So yesterday, the Dow Jones lost about 600 points, and I told you in my morning video that the Dow is looking very, very shaky. We finished in the red. Republicans did gain some traction in the midterms. The losses were in oil and gas, consumer services, and consumer goods. That's not good. That's more of a recessionary signal right there, because oil and gas going down, the only reason that would be is if we were looking further into a recession, which is not a good sign. The midterms did not bring runaway victory for the Republicans. The red wave that they expected did kind of fizzled out. It was a baby wave, but better than expected showing by Democrats, decreasing the possibility of the so-called red wave. Today, as I've mentioned, and we're going to find this out in just a few minutes, I'm hoping, all eyes are focused on the Labor Department CPI. This is a very, very big report, because this will tell us if the Fed is moving towards the 0.50 or staying with the 7.5. Now, what we're looking at, and we'll get an update in a few minutes, we're looking at the core, which is 6.6 and 8 for the year. Now, going back to this, if the number we're expecting, if the number is higher than expected, then this number starts fluctuating and 0.75 is on the table, okay? If the number starts cooling off and it looks like things are getting better, we may see a lower rate. So what we're really going to find out is how these two numbers, the 56.8 and 43.2, how they're going to be weighted out. It'll be very, very interesting, because I think after today's report, we'll have a very, very good idea if the Fed in December is going 0.75 or if they're going 0.50. And I'll check back in a few minutes. Let's see how the stock market's doing. So far, it's holding up okay. It hasn't moved yet, so I don't know if the report is out yet or if it's digesting or if it's what's expected, but we'll find out in a few minutes when we hit it. Meanwhile, investors are looking for the initial jobless claims. Last week, the number was 217,000. They're looking at 220. It's in line. Unless that number really, really goes up, it'll be interesting. Now, this is what the Fed is really looking at, and this is why I highlighted both of these numbers. See that 6.6 right there? That's a huge, huge number. Core CPI, economists look at the number to stand at 6.5, at 6.6 for September number. We'll see if it holds. Asian markets were down along with U.S. stocks. China was down 0.39. Japan was down 0.98. Now, the Shanghai closed lower ahead of U.S. inflation data, as they're still struggling with their COVID policy. And Japan, well, they went down. They were struggling with chemical, petroleum, transports, and railway and buses. These are not very speculative sectors, which is the same thing that happened to the U.S. market yesterday, and that has me worried that the CPI is going to be higher. Let's look and see how the stock numbers are looking. We're still holding up. Let's see how this number is holding, and maybe I can give you a complete analysis. Let's see. It's moving. Let's see if it's in. Sometimes it takes a few minutes for that number to come out. But I figured if I do my report, we'll find out. Meanwhile, let's move on to some other things, and let's see when this stops moving. You're getting this in real time, just like I am right now. So looking at individual sectors, you've got energy, industrial, healthcare, financial, consumer staples. In my opinion, I think utilities is going to continue moving higher. I think industrial is going to cool off, or basic materials is going to heat up. But in a nutshell, I kind of like where we're at right now. You don't want to be long technology. You don't want to be long communication services, consumer discretionary. Those stocks are just, those ETFs are just not looking all that great. Meanwhile, there are some that are looking really good. For example, healthcare looks like it can break out again. Energy, I don't think is going to continue moving a lot lower. So I think there's going to be some reprieve in what we are seeing. But honestly, I think this market is ready to go down some more. Maybe not consumer discretionary because it's a little overdone. Maybe not communication services. Maybe not real estate because it's already close to the base. But the sectors that ran up, like basic materials, really ran up, it can cool off. Financials really ran up. Here they are. They can cool down. Meanwhile, the healthcare sector is near the base, a lot closer to the base. I don't think the number is out yet. Let's see, or it's not representing here. Let's see. S&P is coming down, but it doesn't look like anything's out yet. Sometimes it takes a few minutes for that number to be out. Let's look at the bond market. Let's see if the bond market's reacting. Usually the bond market reacts real quick. Let's see if it's moving higher. Interesting. Very little. It may take the report a few minutes to come out. Another thing that I'm really focused on right now is I'm focused on the volatility, which is going higher. We were short around here. Well, actually, we got short around here. We lived through all of this. It was down like 60-70% the VIX put. And then it started moving our way, but I wanted to get out because I didn't want to be here during the elections and the CPI. I thought that was going to be a little too much, if you will. So again, the volatility is something you need to pay attention to today. CPC, which is the put to call ratio, you need to pay attention to today, which is actually near 1. I wouldn't be surprised to see it go down. Now, looking at the major indices, let me show you something right now. Looking at the major indices, and look at this, we were down 600 something points. The Dow really turned around yesterday and closed near the bottom. I wouldn't be surprised if we started breaking the 200-day moving average. The numbers in terms of small business data, the bond market, nothing is making me feel warm and fuzzy about the Dow Jones breaking higher. And I don't know if you guys noticed or not, but we've been having some pretty nasty divergence here as well. That's telling me price and momentum can't keep up with each other. That's telling me the odds are that the Dow Jones and the broad market is going to move. Let's see if I can get this somewhere else, if I can get the CPI report. Looks like the Fed is not news. Let's see here. No, nothing yet. Nothing yet. It still may be cooking, shaking, and baking. It doesn't look like they wanna tell us what's on the table just yet. Anyhow, remember, today is top ETF and option pick. I'm going to tell you guys something right now. If you look at all of these sectors right now, I would be thinking about going long energy because energy is the strongest sector. In terms of the specific option, or in terms of the specific option I'd be looking at, let's go here. And let me tell you what I would be looking at right now. Now, my suggestion is I think that energy is going to pull off just a little bit more, maybe go down to the 86, 87 level. What I would do is I would be looking at the February. I would be looking at the February calls. There's plenty of open interest and liquidity. And what I would be looking at right now would be probably the 90. It's got great open interest, or the 85. And if you want, you could spread that against the 105 or the 100. They've got plenty of space. But you definitely want to be long energy. Now, you may want to wait for a little bit of a pullback. So you may want to look at these options when they're about $1 cheaper. The 90 may be near the $5 level, or the 85 where it's near the 750 level, but that's definitely something you want to pay attention to. It doesn't look like this is updated yet. The Econo site isn't updated, so we won't know what the number is, but you will know after you watch this video, because I imagine by that time it'll be out. It should have been out 10 minutes ago. So if it's higher than 6.6, then the Fed will say what we're doing may not be having any reaction, but we got to take lag into account. If the number is lower, like 6.4, it may cause a rally in the market, and it may cause the Fed to say, okay, what we're doing is working, so we're going to back away or go 0.50. Again, this number is what we need to pay attention to right now. Now, the bond market, I would not be surprised if the bond market stayed within this channel. If it stays within this channel, then the odds are very strong then that the consumer discretionary sector is also going to stay within that channel, and it's not going to break much lower. The fact that it is breaking lower is not a positive sign for the overall market. I find it very hard to believe that consumer stocks are breaking down, like literally breaking down, and the Dow Jones is right here at the 200-day moving average. That just does not look real to me. It does not look credible, and it doesn't look like it's something that's sustainable, especially if you look at the long-term trend, and you'll see that every time the Dow hits the 200-day line, it backs away, just like it did right here, like it did right here, like it did right here. I don't think we're ready to go above the 200-day moving average just yet. Now, today is going to be a big day for the market. Now, I want to show you guys something very interesting. Now, I want to talk a little bit about clusters. Now, when you're trading stocks, when you guys are trading individual stocks, or even the ETF I gave you today, there's 11 ETFs, right? You'll buy the energy, or maybe you'll buy another one. But what if there was a way that you can create clusters? So, in other words, what if you can go long energy, go long industrial, go long healthcare, right? The juicy stuff, the stuff that's moving right now, or energy, healthcare, and consumer staples. And what if you sell consumer discretionary? Remember, markets drop 3 times faster than they go up. So this should be a perfect hedge for 3 assets, right? So even if the market goes down, you have a hedge. If the market goes up, you've got 3 ETFs, and then you lose all that fat, all that junk in the middle that's holding you back that you really don't need. So you don't need to have that market timing skills, because you're good either way. Our win rate over the last several years has been close to 70%. Our average annual return has been over 150% over the last 5 years, and it allows you to target the strongest ETFs. And what we also do is we target the strongest stock within the sector. So you get the strongest stock that's pulling back and the strongest ETFs. Now, I really want you to check this program out. It's very hot, especially in this crazy market right now, where it's taking us 13 minutes to find out what the CPI is. Let's see if I can get something here on the news. It would be great. But I really want you guys, here we go. There it is. Consumer inflation slowed to 7.7 over easing pressure on households and the economy. All right. So we're at 7.7. We're below. What the Fed is doing is actually working. The question is what the core is going to be and if that's going to hold. But it looks like finally, thank God, the number is a little bit lower. I'm so happy about that. So we could see a little bit of a rally, but I still need to see what the core number is. But it finally looks like what the Fed is doing is working. Now, folks, it's more important than ever that you start trading ETFs the right way. Now, I just gave you one, the energy, but I'm telling you, there's a way to have your cake and eat it too. Less risk, more systematic trading approach, allows you to be really broad with the market, and allows you to have your cake and eat it too. Follow the link below. Check out my alpha rotation strategy. You need to have it in your portfolio right now. You guys are going to love it. Clusters is how professionals trade ETFs, not individual ETFs. 3 or 4 is better than 11. You cut out all the junk. You go with all the strength, and you fade all the weakness. I'll have more updates on the CPI report. Maybe I'll do another video today. If you have any questions, send me an email. But so far, things are looking better than expected. Have a great day. Comment, post your question below this video, and I'll respond. Have a great day, guys, and I'm hoping that this was a little helpful doing it before the opening bell. Bye.